Okay, so today the topic will be market structure. A very, very simple topic to understand. It's not regarding patterns, it doesn't regard patterns, it regards price action. Okay, so you have three main labels when we talk about market structure, but this video will be very different from any type of other market structure explanatory tutorial videos because we won't talk about it as a pattern, but we'll talk about market structure as a price dynamic. So let me show you what I mean by that. You have a trend, you have a channel, and you have a range. Well, we all know what that means. So let me write it for you so it's going to be a bit simpler to understand. Here you have channel and here you have range. So if I ask anybody here to draw a trend, that's going to be easy. Push to the upside, that's an uptrend. Pull back, push to the upside, pull back, push to the upside, pull back. Okay? And if I ask anybody to do a downtrend, that's going to be push to the downside, pull back, downside, pull back, downside, pull back, by respecting, of course, the levels always. Either if it's an uptrend or a downtrend, respect the level. So breach the level, pull back to the level, comes back, pull back, break and retest type of stuff. I mean, you understand what that means, right? Then, if I ask anybody to draw a channel, it's going to be either an upward channel or a downward channel. So an upward channel might look like this. So it's kind of an uptrend, but it pulls back really deep, and when it goes back to the main trend, it doesn't go back to the upside if it's an uptrend that much, or to the downside if it's a downtrend that much. Okay, so it stays around um around the levels without really breaching anything, um and without respecting either the upward level or downward level. Okay, and if I ask anybody to draw a range, it's just the price hovering around two levels, right? So let's say we talk about a trend to begin with. Okay, a trend. A trend might look like this. Okay, I'm going to draw an uptrend for the sake of simplicity. We're going to stick to uptrends and to upward channels. Okay, that's a trend. So let's say here you have a price of 10. Here at this level, you have a price of 15. At this level, another high, you have a price of 20. And at this level, the last high, you have a price of 25. Okay? Now, in terms of pricing, you see that this is the same size as this, is the same size as this. Not my drawing, but the prices. Look at this, 5, 5, 5, right? And when you look at the pullback, let's say the pullback, each pullback pulls back 50% of the push up, okay? So this is 50%, this is 50%, this is 50%. So if nothing changes and the dynamic stays the same, what happens? You would expect this from the moment it's going to reach 50% to go up by 5 and to reach basically 30, right? Here, 30. That's what you would expect. Now, imagine some details about the price changes, right? So let's see. If we have some details changing about the price, what's happening then? Okay, so let's say here we always begin at 10. It pushes to 18, so it pushes by 8, then to 22, then to 23. Okay, what do you see here? you see that this push is bigger than the second push. The second push is bigger than the third push. So here you see it's 8 the difference, here 4 of difference, and here 1 of difference, right? So you see a momentum fading. On top of that, imagine that the pullback here is 50%, the pullback here is 60%, and the pullback here is 80%, meaning it's going to pull back a bit lower, right? What do you expect then? So you see the momentum fading and the pushes, the power of the pushes is reducing. So you would expect, for example, this push to the upside back won't make a new high, reaching its limit, probably going into another type of market structure that might either be a range and a bridge to the downside, for example, right? So now you're thinking in terms of scenarios, you're understanding the price action, the price dynamic. Let's talk about another type of scenario, right? Okay. Let's say, for example, it pushes to 10, 10 to 12, 12 to 20, 20 to 30, right? Now the dynamic has changed. Here it pushes by 2, here by 8, here by 10, right? So this is smaller than this push, and this push is smaller than this push. So it's picking up momentum more and more and more. So what do you expect from this is a push higher. You could expect it higher than 10. So basically you could expect a push that would grow by 10 and reach 42, for example, by 12 and reach 42, right? Because the momentum is rising, and you could expect the rise of momentum to continue and the push up to continue, right? Okay, so this is an uptrend. Now, you might explain a channel or a range, that's a range, or a channel in the same way in terms of price action. What price did it reach? What price it didn't reach, and why? And how is the momentum in that? So basically here you see, for example, imagine it's between 10 and 8. You know that at 8 the price has a tendency to go to 10, and at 10 the price has a tendency to go to 8. So for example, if you are at 8, you wouldn't be thinking about selling, you would be more inclined to buy, because historically and currently this is what's happening. Same thing here in a channel. Let's say you have a channel and these prices, this is for example 10, then 11, then 12, yeah, and it reaches here as well, 13, 14, 15. It's gonna be hard to trade, right? Because it's very, very small movements. However, when you're gonna be closer to 10, you'll be more inclined to buy. And when you're gonna be more close or closer to 15, you'll be more inclined to sell. So you understand which areas are pushing the price towards which direction. And when you remove the labeling of a chart pattern, or how the chart looks like, does it look like a trend, does it look like a range or a channel, you remove it and you replace that labeling system by a price dynamic understanding, everything will change for you. Everything, I mean it, I mean everything will change, because you'll start understanding what is happening. Okay, now let's try to draw a random chart. Just for the sake of explanation, we'll start with an uptrend and then we'll reduce the momentum towards the channel, will move towards a range. You'll see a push to the downside, range in again, push back to the upside, pulling back slowly, pushing up, right? Pulling back up more, and then continuing up. Okay. I'm not making it complicated, I'm making it complete, right? So let's say here you have a price of 10. We always begin by 10 for the sake of simplicity. And then you see the price reaching 15 and pulling back at, let's say, 13 or 12, 13, let's say 13, right? Then the price pushes again and tries to reach 20. Yeah? Pulls back at 18, pushes again, and let's say it reaches 23 and pulls back at 21. What's happening here? You see the price pushing by 5, pulling back by 3, pulling back by 2, reaching 13, and this is an information that you have no use of if you don't have the next information that is coming. Then you see the price pushing upwards, 20, pulling back by 2. So nothing changes, right? So at this point, you might need a bit more information, but if you have enough information, you could say, oh, the price will probably continue moving upward. So I might have a small confirmation here and buy from there and make a profit. However, instead of rising by 5 now, it rises by 3. And instead of pulling back, and it does pull back by 2, however, it pulls back lower in relation to the push to the upside, right? So let's say, if we talk in terms of percentage, if you have 10 plus, okay, a push of 10 pips to the upside, for example, so plus 10 pips, right? And it pulls back by 5, that's 50%. But if you have a push of 5 pips and it pulls back by 5, same pullback, however, that's 100%, right? You don't like that. You like that because that's less aggressive. You don't like aggressive pullback because aggressive pullback means a slow momentum, a slow of momentum. So when you have this and you see that the percentage of pullback is higher here and it's getting closer, even breaching this level, that's a red flag for you. You want more information and you're like, okay, what's happening? Will the uptrend continue? And then it tries to push up, but it pushed up to 24. And then you're like, okay, the momentum is dead. The momentum is dying now. What's happening? We were at a consensus price here. Everybody was happy, buyers and sellers. That was a range between, let's say, 11 and 9. And from 10, we pulled back up. And okay, what's happening here? We pushed up and then we slowed down and we have another push to the upside. Now what's happening here is very simple to understand if you actually saw the previous videos we talked about now. And we talked about consensus price. And a consensus price is basically the fair value of the asset you're trading. So if the buyers and the sellers, quote unquote, market participants, are happy with the price of that asset because they have use of it, you'll see the price not moving that much. But let's say you have new information, for example, a news release coming in the market. Here, what's going to happen is that the fair value in the eyes of the investors and people who have use of it and the institutions, the fair value of that asset might change with that new information, okay? Let's say news, right? You'll see the price changing and then it's going to slow down and it's going to start hovering around not going back down, not going back up, just hovering around, being a range. You can trade a range if it's a big range, if it's a large range. But you don't want to start trading micro pips. This is very dangerous if you don't have the proper machines, and you want to have the proper machines if you're a retail trader. Okay, so this is what's happening. And then you're like, okay, let me see if everybody's satisfied with the price, if people see it as too high, if people still see that the actual value of that asset needs to be higher. And then you see a breach to the downside, okay? And you're asking yourself, why is there a breach to the downside? Why did the price push back to the downside and hovered around these levels, 2021, and just stayed here? Because that was the last push to the upside before having that range. You want to make sure that it's not basically trying to reach back here where the previous consensus price was. So you want to ask yourself, did the consensus price change again? Is that asset still super valuable so people want to buy it more? What is going on? Okay? And this can be for multiple reasons. It can be a news, and if it's a news, it has higher chance to continue going down, because maybe that news told the investors, and in the eyes of the investors, that they were wrong about that consensus price, about that fair value, and the fair value is actually the fair value that was there then when they were trading at around 11.9, right? But this didn't happen. You wanna wait. So you waited, you see that push, you wanna make sense of it. And by making sense of it, you wanna have multiple snippets of information. And on top of that, you wanna see more information of how the price is reacting. And you see the price just hovering around here. And here you're really asking yourself the question of, hey, this doesn't really make sense to me, so I want to see more. I want to see more. The more you see, the more information you have, the more smart you can be. If this is the close of a session, that push to the downside might simply be traders taking out that money of the asset. So it's not selling the asset, it's simply taking out the money. It's not betting against the asset, basically. It's selling back the asset from the bet they had that the asset would be more valuable. So let's say they took their money out of here, and you see that price crashing here and just hovering around, and then you have another open. If that's the case, it's pretty straightforward to understand, because you'll be able to see that, hey, that might be just investors taking their money out, and this might be a no activity zone. And then you see the price pushing back up here. Now, the reason why the price is not pushing back higher is because this area, when you understand that you have market participants that understand how the price dynamic works, so you want to tune with them so you can ride the flow of the price, you want to understand that this level, because of this push to the downside, created, that's not a scientific term, by the way, but it created a kind of trauma. So people will remember that price, and you'll be like, hey, at that price all the time you had orders selling the price down, and here you had orders selling the price up. But this order block, this area where you had buy orders, got breached to the downside. So you'll see the price reacting from these levels, either because you still have selling orders there, or because people are reacting from that level because of what happened previously. And you see that push to the downside. However, this push to the downside is very different from this one. This one is aggressive. So let's say here you reached 28, and you have a push going back to 22, but not like this, in a very slow way. that is a pullback. It's like if you go to the lower time frame, you're gonna see this, but inversely. You're gonna see a range going down, and then you're gonna see a channel forming, and then you're gonna see a trend going down, then a channel forming, and then you're gonna see a range forming, and that's on the lower time frame. So if you zoom in, and then you see a big push, an aggressive push. If that aggressive push is because of a news again that has purpose, or new information in the market, or the same information in the market, but people now are satisfied with that price and buyers want to buy more and there's more demand, so there's multiple things going on that you're going to see that you need to like have and build the puzzle out of them. And on top of that, look at the price reaction. Then you can tell to yourself, hey, this looks like the price will start going back up because it recovered, it corrected. So this was a correction phase, all of this, right? It recovered, not even this from here, okay? This. So this was a correction phase. It recovered, and now you see the price pushing to the upside, breaching that level without reacting anymore to it, just hovering around. That is your confirmation, and you'll see the price going back up. This is not to show you where to get involved and where to not get involved. This is to show you that there is a price dynamic. It's not about a pattern. It's about the dynamic of a price that is understandable, that is picking momentum or slowing down in momentum, that is showing the market interest into a certain asset or disinterest into a certain asset, that is showing how market participants in general, buyers, sellers, people, and all the people we talked about in previous videos, this shows you how is the market reacting with all these people involved and how the price is reacting, basically the dynamic of the price, how the price is moving and how you can take advantage of it. So if you understand this, you have a lot of knowledge. That's a big base that nobody talks about, and people need to talk about it. Most retail traders will label things. Do not label things. Avoid labeling patterns. Avoid talking about patterns. Avoid talking about it. There are some regular patterns, but this is not the point. It's not the point about recognizing patterns without understanding what's the intrinsic meaning about the patterns. What you need to understand is what is the price doing. And as long as you understand what is the price doing and why the price is moving like that, then, only then, you can understand what is the true meaning of a pattern. Because a pattern happens by showing, a pattern is basically labeling a price movement. You don't want to label a price movement because you might recognize a pattern somewhere that is not necessarily the pattern that you always see and take advantage of and make a profit out of. This is what people, for example, traders would learn patterns, go into the market, think that this is what they saw in that video that they learned from, without understanding the real dynamic behind that pattern, the real price dynamic behind that pattern, and they would keep losing money and keep losing money and keep losing money, and they wouldn't understand that the market also changes of dynamic, so they would keep losing money, not see that pattern anymore, and dry themselves out of cash. Basically, they will think it's a scam, they will think it's psychology, they will think it's mentality or mindset, but it's none of that. It's knowledge. It's the lack of understanding what is noise, what is valuable information, what is good to do, what is bad to do, and what is bad to do is basically labeling. Labeling is very bad. So if you keep labeling things, you'll keep missing the point. And missing the point is basically the definition of a sin. If trading was a religion, patterns would be a sin. Psychology would be a sin. Okay? Because it's all about missing the point. The point is price dynamic, economy, and how society and participants within that society make the price of a particular asset move. If you understand that, you already understood trading. Okay? But we still have a lot to cover. So let's jump to the other video and I'll see you there.